Social Security is running out of money. So if you or your parents or your bro cousin Bunty are thinking about retirement or retirement planning, you're going to want to watch this video until the end. Here's how Social Security works. You go to work to get paid. And let's assume for the purposes of this video that you make $100,000 a year because it's a nice round number. So you go to work and you generate this $100,000 a year in salary. You are going to pay Social Security taxes on this salary. Now notice how I'm saying salary, because if you earn this money from your stock market investments, you don't pay Social Security taxes. If you earn this money from your real estate investments, you do not pay Social Security taxes. If you make this money from your business profits, you do not pay Social Security taxes. You only pay Social Security taxes on your W-2 salary income. So you make $100,000 in salary from your job, and now you're going to pay some of this money in Social Security taxes. Right now, at the time of me recording this video, the Social Security tax rate is 6.2%, which means if you make $100,000 in salary from your job, the first thing that's going to happen is you're going to pay taxes, and one of those taxes is the 6.2% Social Security tax, which means $6,200 of this $100,000 is going to go into this, we're going to call it the SSF, the Social Security Fund. But that's not all. Because your employer, your job paid you a salary, they also are required by law to contribute to the Social Security Fund. They're also going to pay 6.2%, which means your employer, your boss, your company, whatever you want to call it, is going to also contribute $6,200 to the Social Security Fund. Now, if you're self-employed, meaning you own your own company, now you're going to pay the Social Security tax, and your company, meaning yourself, is also going to pay this. So you're effectively paying 12.4% in taxes if you're self-employed. So the employer is going to pay 6.2%, you're going to pay 6.2%, and this only applies to your salary, and this Social Security tax only applies on salaries up to $176,100 in 2025 at the time of recording this video. So if you make $200,000 a year, you're only going to pay these Social Security taxes up to the $176,100, and every dollar you earn beyond that, you do not have to pay this additional Social Security tax, but just have to pay all of your other federal income taxes. Now here's what's supposed to happen next. This money gets contributed into the Social Security Fund, which gets invested. I'll explain how and where it gets invested in just a little bit, but this money then sits there. It's supposed to grow because it's being invested, and then when it comes time for you to retire, now the Social Security Fund is going to pay you money every single month. That way you have money to live a comfortable retirement. But there's one problem here. This Social Security Fund is beginning to dry up. Let me read you what the Social Security website says. If nothing changes, the Social Security reserves would become depleted between 2033 and 2035, which effectively means the money that you've been investing into the Social Security Fund to fund your retirement is being used to fund somebody else's retirement, and it's starting to run dry. Now this is where there's a lot of false information out there. Like some people are talking about how you're not going to receive a Social Security check, which is not exactly true. Here's a little history lesson. Starting in 1983, this Social Security Fund was actually running a surplus, which meant there was more money going into the fund than what was going out, which meant every year the Social Security Fund was actually growing, but that changed in 2021. In 2021, we saw a deficit, which meant more money went out than what was coming in. Beginning in 2021, due to increased longevity and a decrease in the number of workers per beneficiary, Social Security began tapping into the surplus fund to meet its obligations. So starting in 2021, as this money was entering the Social Security Fund, more money kept going out than was coming in, which meant now this fund started to get smaller and smaller and smaller, which is why now the Social Security Administration says that we have about a decade or less than a decade left before this fund gets depleted if nothing changes. Now, in order to understand what you should do, you got to understand why this is happening, and there are two main reasons why this is happening right now. Number one is that there are less workers than beneficiaries, which is the little bit more obvious part. And then there's number two, which is the loss in value, which is the part that many people overlook, and I don't see really anybody talking about this online, but I really want to hammer this point home as well. So let me start by explaining this: less workers than beneficiaries. Back when the Social Security program started in 1940, there were about 40 workers for every one beneficiary. beneficiary. But of course, this is a little bit skewed because back when the Social Security program started, you had generally a lot of people working to get that program and very few people getting it because the program had just started. By 1950, you had 15 workers for every one beneficiary. By 1960, you had 5.4 workers that were being taxed the Social Security tax, contributing into the fund for every one beneficiary. And as of today, you only have about 2.8 workers that are being taxed the Social Security tax for every one beneficiary of the Social Security checks. Now, it's very easy to see the problem, and you might be wondering, well, why is this happening? And there's two things happening at the same time. Number one, people are living longer, so they're collecting checks for a longer period of time, and there's less people being born. So there's less people being born that are working to contribute money into the Social Security fund. That means there's less people that are going to be taxed to contribute into the Social Security fund. Take a look. Baby boomers are the ones that are retiring right now, and there's a lot of them. 76 million baby boomers retiring to start collecting the Social Security checks, but only 65 million Gen Xers, only 72 million millennials, and only 69 million Gen Zers. So it's less and less of each following generation as opposed to more people going out to work to pay for the baby boomers to retire. And not just that, the people that are retiring are also living longer, which is pretty obvious. People are living longer today than they were 100 years ago. But what's interesting about this is the Social Security program actually knew that people living longer would be a problem. For example, the first recipient of the Social Security check starting in 1940 was a lady by the name of Ida Mae Fuller, and she ended up living until 100 years old. So the first recipient of the Social Security checks got those checks until they were 100. So they knew that this would potentially be a problem, but then in addition to that, we have the lower birth rates. So we can see how this is contributing to the smaller Social Security fund, which brings us to here. By the way, if you like to stay up to date on things like this, on what's happening in the economy, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where we break down what's happening in things like the economy and the stock market and the housing market and the crypto market and the global economy into a fun and witty and easy to read newsletter. You can read it in less than 5 minutes every morning, and we have hundreds of thousands of investors that are reading Market Briefs every morning. So if you have not joined Market Briefs yet, I think you will love it, and I have the link for you to join down in the description below. Do you remember what I told you a little bit earlier in this video, where the Social Security Trust Fund collects your Social Security taxes and then it invests this money for you? That way when it comes time for you to retire, you'd have more money. Well, the interesting thing about this is the data on the returns that the Social Security Trust Fund gets is published online. And we can see the returns here on this chart, but let me just highlight the last few years that we can get an idea of what's going on. So the Social Security Trust Fund takes their Social Security tax dollars, and they generally would invest this money into treasuries, meaning lending this money to the United States government, because it is a low risk investment. And these are the effective interest rates that they got between 2019 and 2023 published on their website. 2.8% in 2019, 2.6% in 2020, 2.5% in 2021, 2.4% in 2022, and 2.4% in 2023, which means your money over this 5-year span grew by around 9.1%. This is the total growth of that money between 2019 and 2023. Why am I showing you this? Because you might also remember that during this period, we also saw a lot of inflation. We all remember that, right? Still feeling the effects of it. Well, we compared this to inflation over those same 5 years. What we saw is that between 2019 to 2023, the total reported inflation rate was around 18%. So we saw around 18% inflation, while these investments, if you want to call them investments, grew by around 9.1%. So they grew by around half the rate of inflation, which meant they didn't grow, they actually lost value. But that's not all. There's one more part to the story which I haven't really mentioned yet. So we know that there's less people working to contribute into the Social Security Fund. We know that people are living longer, so they're drawing these checks for longer. And now we know that this money hasn't been growing fast enough to keep up with even inflation over the last 5 years. The other part to this, which I haven't mentioned, is that the money that the Social Security Fund is paying out also has been growing to keep up with inflation, or to try to keep up with inflation. Now, what many people have experienced is that the check growth that they're getting isn't keeping up with inflation, but that's still a higher cost out of the Social Security Fund. Let me show you exactly what I mean. In the year 2022, this was when we saw the peak inflation post-pandemic, and the reported peak inflation in 2022 was 9.1%. That was where inflation peaked out. And then in response to this 9.1% inflation, the Social Security Fund said that they're going to go out and increase Social Security payments by 8.7%. This is called a cost of living adjustment. So the Social Security Fund increased their payments by 8.7%. Their fund only grew in interest by 2.4%, while inflation is 9.1%. So you can start to see a little bit of a problem. They're paying out more money, they're not getting as much money coming in, and the money that's in here is not growing fast enough to keep up with inflation. It's a triple whammy. So the way Social Security taxes work is you're going to pay Social Security taxes on your W-2 income up to $176,100 at 6.2%, and your boss is also going to pay that 6.2%. If you're self-employed, you're going to be paying both of those 6.2%, effectively 12.4%. This money goes into a Social Security fund, which then gets invested into treasuries. Then the money that's invested in treasuries doesn't grow very fast and has not kept up with inflation. Then the other problem with that is not only is it not keeping up with inflation, but we also have less workers that are contributing into the Social Security Fund, while there are more beneficiaries because people are living longer and there's less people that are working in our economy to continue contributing. Along with that, we're seeing a loss in value because the money, like I just showed you, in the Social Security funds hasn't been growing, while the Social Security checks have to keep getting bigger, trying to keep up with inflation. So you can start to see the problem. And this is why the Social Security Administration says that if nothing changes, the Social Security Fund will dry up. But we all know that there's a couple things that can be done. I mean, they could raise taxes on Social Security taxes. They could go out and print more money, which would create more inflation. But the real solution here for you, if you're thinking about retirement, if you're thinking about retirement planning, is how do you build your wealth? That way you can live your life the way you want and not have to rely on the government to take care of you, and not have to rely on the Social Security checks, because if you ask anybody who's relying on Social Security, they're not going to be a happy person telling you that, yeah, the Social Security check is funding my dream lifestyle. No, if you want to be able to do that, you have to change your retirement plan right now. And this is where you can do one of two things. You can rely on a financial advisor, or you can do it on your own. I'm not going to tell you which one's right for you. I mean, I'm just a random guy on YouTube. I'm here to help show you the different opportunities. That way you can make better decisions with your money. Now, when it comes to financial advisor, look, go out and find a good financial advisor if you want help doing this. If you want a recommendation, my partners at Money Pickle, they are an advertiser for Minority Mindset. They can recommend a financial advisor for you. It's a free service where they will work with you to help you find a financial advisor that fits your needs. They work best for people who have at least $100,000 in investable assets. So if you want to learn more about them, I have their link for you down in the description as well. If you want to do it yourself, in conjunction with a financial advisor, or 100% yourself, that means you have to do a couple things, and I'm gonna wipe this off and show you. If you really wanna think about retirement planning, the way that it works is you have to invest your money and you have to get a better return than what the Social Security Administration is getting. That way you can actually become wealthy. And that means, number one, you have to understand how to use your income. Now, this does not matter if you're earning your money from your job, a W-2 salary, or if you're a 1099 contractor, or if you own your own business. You're making an income. Now, what happens when you make this income is the government's going to tax you, right? We just talked about this one form of tax, the Social Security tax. Another form of tax is the federal income tax. You have a lot of different taxes that gets taken out of your paycheck before you even see your paycheck. And the reason why the government does this is because they know that for the average American, if you don't pay these taxes right away, you're probably going to spend that money and the government's never going to see those taxes. That's why they take the tax right away. And then what ends up happening for the majority of people is you take whatever's left and you go spend it. Maybe you pay for your rent, you pay for a vacation, you pay for your groceries, you pay for whatever you got to pay for, but you live your lifestyle based off of whatever money is left. Because if you had more money, if you weren't paying these taxes, a lot of people would spend that money, and that's why these Social Security taxes are taken out right away. Now what I want you to do is tax yourself. If you really want to think about retirement planning, if you really want to think about becoming wealthy, you have to tax yourself. And that means taking money, putting it aside, not giving it to the government, not giving it to the Social Security Administration because they're clearly not doing a good job, and now taking this money and putting it to work. That way you can actually build wealth. And that means you can't spend all of your money. Now, a simple rule of thumb that you can follow is something like a 75, 15, 10 plan. If you've been following my channel, you probably heard me talk about this at some point, which says for every dollar that you earn from here on out, 75 cents is the maximum you spend, 15 cents is the minimum you invest, 10 cents is the minimum you save. But the focus here that I want to talk about is the 15 cents of every dollar that you earn that you're putting aside into your investments. Because this is where you become wealthy, right? This is what the government's trying to do. This is what they're trying to do with their Social Security check, that they're trying to take this money and invest it for you, but they're doing a very bad job with that. And your Social Security checks, unfortunately, are being used to pay for somebody else to retire, if that. So now, you want to put this money aside, which yes, it's going to be difficult. Yes, that means you got to make sacrifices. Yeah, that means you might have to cut back on your lifestyle. But if you really want to build wealth, there's no other way to do that. You can rely on the Social Security checks, but we see how that's a problem. If you really want to build wealth and be able to not have to worry about money, you have to make the sacrifice today that we don't have to worry about money in the future. And you got to pick your hard. Either it's going to be a little hard right now, or it's going to be really hard in the future. So you put this money aside to invest. Now the question is, how and where do you invest your money? Now I have a lot of videos where I go a lot deeper into that. But what you really want to understand is how involved do you want to be with your investments? Do you want to be more of a passive investor, or do you want to be more of an active investor? When I say passive investor, I mean a set it and forget it investor. Do you want to just invest your money into mutual funds, index funds, ETFs, real estate crowd funds, or other real estate funds where you're not actually involved? You just throw your money into something, you don't worry about it, and you just hope that this makes you more money. This is a lower risk, lower potential return way to invest your money, but it's less time on your end. The alternative is active investing. Active investing is not trading. This is not you going out and trading stocks, day trading stocks. This is not you going out and flipping real estate. This is you finding good long-term investments, but being more involved with these investments. Listening to company earnings calls, studying financial statements, looking at individual real estate investment deals, investing in startups, investing in more individual things where you're putting in more work. It's not set it and forget it. It's more time, it's more work. It's more risk, because if you invest your money into, say, the next Sears and they go bankrupt, all your money's gone. But if you invest your money into Amazon before people know it's Amazon, you can make a whole lot of money. So higher risk, higher potential return, but more time, more work. So you have to decide what's the right strategy for you, and based off of that, come up with a plan on how do you actually invest your money. For example, what I like to say is for 98% of America, the way that you should be investing is through a strategy that I call ABB. Always be buying. This is a passive investing strategy of how you can build wealth in the stock market. You take this money right here, this 15%, and you can direct deposit this money directly into the stock market. You're not going to put this money into Amazon or Tesla or Nvidia. You're going to put this money into the economy. For example, now I get it, I'm just a random guy on YouTube. I'm not a financial advisor. I can't tell you what to do. Take everything that I say with a grain of salt and do your own due diligence. But as an example, SPY is an ETF, meaning it's a fund that gives you exposure to the 500 largest companies in the stock market. This is not investing in one company, you're investing in the broad American economy. Now, I want you to understand, our economy will go through another recession. We've seen 16 recessions in the last century. Our stock market will see another market crash. It's a part of our economic system. But the key with ABB is always be buying, is you want to have a strategy where you're buying every week, or every 2 weeks, or every month. This way now, you find a few funds that you want to invest in that are giving you exposure to the broad economy, whether it's the S&P 500, whether it's the total stock market, whether it's some other broad economic index, and then you just ABB. You ABB when you're going through a market crash. You ABB when you're going through a recession. You ABB when you're going through a market boom. You ABB when nothing is happening in the economy. You just ABB all the time. So you make money, you put this money, and it's just ABBing into the markets. That's how you build wealth with the strategy, because what we have seen is that markets have grown by around 10% a year on average for the last 100 years. Despite the 16 recessions, despite the market crashes, the stock market has grown by around 10% a year on average a year. That's one way to do that, because we know that even if you do a little bit of money for long enough time, you can retire a millionaire. $100 a month for 45, 46 years at 10% a year will make you a millionaire. Now if you say, well, Jaspreet, I don't have 45 years. Okay, then invest more than $100 a month. The more money you invest, the wealthier that you can become. The alternative now, if you don't just want to be a passive investor, you want to be more of an active investor, now you want to find more unique investment opportunities. I talk a lot about this on my channel. I talk about this stuff in Market Briefs. If you have not joined Market Briefs yet, again, I have the link for you down in the description. This is now you being more involved with understanding what's happening. That way you can find a unique investment opportunity. You're looking for shifts in the economy. You're looking for shifts in changes in spending habits. That way you can find an investment opportunity that will hopefully have a chance to grow. Now, of course, there's no way to mitigate all of your risk, but you're taking higher risk for higher potential return. The problem that so many people make is, number one, they have no idea what they're buying. They're buying a random stock that they heard about on Reddit or Instagram or some random YouTube comment or a random person on YouTube. Or number two, they have no idea of how to manage their investment. You buy a stock that might actually be a good stock, it might be a good investment, But then, markets start to go down a little bit. You see your portfolio in the red, and now you get scared. You think you're a long-term investor, but then immediately, as soon as markets start to go down, you panic and you sell because you get scared. Markets go down 4%, 8%, 9%. You panic and you sell. When in reality, if you want to be an investor, you have to have a long-term horizon, a long-term mindset, which is not 6 months, it's many years, maybe even decades. That's how you build wealth. It starts with you understanding how to use your income. And then it starts with you then taking that income and investing a piece of it. And then you have to know how you're going to invest your money. Are you going to be an ABB passive investor, or are you going to be more of an active investor? Once you do that, the final step to this is to ramp this baby up. Pour some fuel on the fire, because once you understand this game, now it's time to pour some fuel on this fire. And the way you can do that now is by working to increase your income. This might be working harder at your job, might be working to get a career change, working to get a job change. Maybe it's working to start a business or a side hustle. Depends on you. But now as you earn more money, you have a system. The mistake that most people make is they work to earn more money so they can drive a better BMW. But the game that I want you to play is you're working to earn more money so you have more money to invest. Sure, yeah, now you got some more money to spend too, but this is where your wealth is going to be. Your wealth is not in the nice things that you have. Your BMW is not making you wealthy. The Rolex is not making you wealthy. The trip to Cancun is not making you wealthy. But those investments, which you can't show off, are making you wealthy. And that's how you really plan your retirement. That's how you plan your wealth. So we know that there's a problem with Social Security. We know that the government hasn't been the best with their money. We know that the Social Security fund is going to keep pulling money out of your paycheck. Now the question is, despite all these issues, how do you win? The way that you win is by number 1, learning how to use your income. Number 2, learning how to invest your money. Number 3, putting that money to work. And then number 4, working to increase your income. That way you have more money to invest. That way now you can actually build your wealth and not have to rely on the government's checks to live your life. If you get a Social Security check, great, it's just icing on the cake. But this is true retirement planning when it comes to money. The last part is, what do you want to do when you retire? Because there's a saying that those who retire early die early, because what ends up happening to a lot of people is if you don't have anything to do, you just come home and you sit and watch TV all day and night long, and now you can become miserable and you start to develop a lot of problems. So I'm not going to talk about that in this video, but think about what you want to do in retirement. That way you can live your purpose as well. And it might be a little bit easier when you have the money to fund that purpose too. Our economy is going to change in 2025. And in this video, I want to show you how you can find the investment opportunities that most people are overlooking. Take a look. President-elect Trump is entering the White House in January, and he wants to make some sweeping changes to our government and economic policy. Let me show you why this matters. In 2024, the United States